Hi, I'm Ross from Coon Smith 150 Group Property Accountants, and we're just going to look at something a little bit different today. We're going to look at some commercial property example. So obviously, as property investors, you're always looking at different things, and you're always thinking, is the grass a little bit greener on the other side? Is it better to go out and do some property trading? Is it better to buy a commercial property, or is it even just better to have a new build? And obviously, there's so much talk about it at the moment. Lots of people are always pushing, you need to go and buy a new build. You need the tax deductions. It's so much better. And if you've watched me speak, it's not about being a new build or existing. It's about buying a property that works for you. And generally for residential property, it's all about buying something where the numbers actually work, or it's got potential. It can subdivide it. You can add a duplex on it at the back, something different. And generally a stock standard property just doesn't work. Well, the other one is commercial property. Obviously, commercial property still has tax deductibility. A lot of people are looking, should I go out and should I buy a commercial property? Well, the first thing is there's so much more to it. So we're just glancing here at a commercial property on realestate.co.nz. I'm not selling the property. It's not related to me in any way. It's the first property I could find with a dollar figure on it. So obviously there's a whole lot of different things to think about. You've got to look at what is the earthquake? What's the risk with that? Car parking can be a big one. What's the sort of thing? And today we're not going to concentrate on all those things. We're just going to go the simple, what do the numbers actually look like? So we've got a property here, 53,000 of rent, and what's the potential rent? I have it investigated and checked it. And obviously this is it's got some residential and some freehold, but let's just say it's straight commercial to make life easy. So we're getting 53,000 rent on 875,000. How does that actually look for numbers, and does that make sense? So first thing we're looking at, what is the gross yield? So we look at the same with commercial property, but it's so much more important. So with residential property, so much more important with commercial. So 53,000 of rent, buying it for 875,000. It's plus GST, which is normal in commercial. We've got a 6% yield. And just like anything, I'm generally looking for advantages. I'm looking, can I add value? Can I subdivide it? Can I do something like that? I want a good tenant. I want a long-term lease. Lots of different things to look at. But if we look at the basic numbers, gross yield 6%, not long ago, we would have been going, that's about where the market sits. The problem is when we look from a cash flow point of view. So we buy it for 875,000. Say we can borrow the whole 100% as a commercial loan, and maybe it's 6% the commercial rate at the moment. So we pay 52,000 of interest. Say the bank requires the commercial loan to be paid over 10 years, which is the standard. So we have to pay 64,000 of principal. Okay, so let's go through those numbers. We've got 53,000 of rent. We're paying 52,500 in interest. We're making $500 a year. Woohoo! Let's go celebrate and let's go spending. But no, in reality, we're making a tiny little profit. Then we're going to get some depreciation. Generally, commercial, you can depreciate a lot more. We can depreciate our internal walls. We can, our partitions. We can depreciate electrical, plumbing, basically every little thing within that property. We generally get a lot more depreciation. So you'd hope that's a little bit more. And so for tax purposes, we're making a loss. Maybe we're getting a tax refund if we're lucky, offsetting it against some other income. So we're making $500, getting a tax refund. We're all happy, but then we've got to pay this principal. So principal, 875,000 over 10 years, we have to pay back 64,000 per year. So what obviously happens with cash flow is we're minus 60,000. Ouch. So yeah, you buy a stock standard property, it's making a stock standard yield. We said it was a 6%. But our cash flow is shot because you've got to pay all the principal. So let's see if we can prove it. Maybe it was over 15 years. So over 15 years, we're down to 36,000 of principal. Still 32,000 loss, or 32,000 you have to put in. Still ouch. Maybe we could split that. Maybe we could get 40% on our personal house and borrow the 60% on the commercial. Maybe personal is 5% over 25 years. So yeah, we're making 53,000, still paying 49,000 interest, $4,000 cash profit. This depreciation is -6, getting a little bit of tax back. So cash profit 4, getting some tax back. Yeah, we're actually getting ahead there. Problem is, we're still got to pay 30,000 in principal. You're still 22,000 down. So what I'm trying to highlight by this is, if you buy stock standard residential, it generally doesn't work. A new build, yes, it's tax deductible, but still the numbers do not work. They're terrible cash flow. You buy a commercial property, it's the same. If you buy the stock standard property and yeah, you just rent it out, getting a 6% yield, unless you've got a whole lot of cash in the bank, you're not going to do well from it. It's not great cash flow. So yeah, potential of interest rates going up, this could cost you more. And even by splitting it, making it 15 years, if the bank will allow that, putting 40% of it on the residential over 25 years, you're still 23,000 a year that you have to put in. So yeah, the key sort of concepts or takeaway from this is you need to add value. You need to do something smarter than that. Even if you've got a whole lot of cash, and I can actually show that example, what would happen if you've got lots of cash in it? So let's say you put in some money. So let's do those same numbers we did before. And let's say you put in 268,000. Let's up those interest rates a little bit. We're definitely not getting 4% for commercial. And yeah, let's do it the same 25, 15 years. So you've put in 268,000. That brings the interest down to 32. You're making a good cash profit, less the depreciation. You've got taxable profit, paying some tax. So cash profit 20, less your tax, less your principal, you're still $904. So your surplus, you're still making nothing, no return on your money. So you've got 268,000 in here, but you're getting no cash return because it's all in principal. As a taxable profit, as a return, you're about 4%. So yeah, however you look at this property, if you look at straight cash flow, it's going to lose you money because you're going to have to put in lots of principal. Return on your money, if you did put some money into it, 268,000, it gets it break even, but you're still not really getting any cash out, or you're actually losing a little bit. And yeah, your return as investment, still pretty average. So yeah, have a good think about this. We've got a whole lot of webinars coming up. Watch out. I think we've got 5 or 6 coming up over the next month or 2. So watch out for those. They've got really good information. If you haven't reviewed your portfolio, worth having a meeting with me. We start off with a free chat. Just a great way to see, is there something simple we can do? What's the next step? And most likely, yeah, worth having a review of your portfolio with me. Can you move around debt? Is there something you can do smarter? Just a meeting today, about an hour ago, simple little thing we could do, little tiny twist, tiny, no real cost, 2,500 tax saving a year. So really worth getting that review with me and just going through your scenario and seeing what you can do better. Looking at buying and selling, the same. What are the numbers actually like? Is it a good property? I'm very blunt and straight up, and I'll tell you if it's a terrible property. So worth going through that. So hopefully you've got something from that, and hopefully we'll hear from you. Thanks a lot. Bye.